Good afternoon, everyone, and thank you for joining us on today's call with Marla Ducaran and S&P Analyst for Trinidad and Tobago, Julia Smith. Marla, I'm going to go ahead and turn the call over to you. Your mic is unmuted. You can go ahead. You're on the broadcast.
Thank you, Melissa. And good afternoon to everyone on the call. Good afternoon to Julia. Thank you so much, Julia, for agreeing to join us. I really appreciate that you've taken the time. You've had a very busy week, and I'm very grateful that you've agreed to join us to discuss this very important matter here in Trinidad and Tobago today.
Hi, Marla. Hi, Melissa. Thank you for having me.
So Julia, you might have seen that following the release of your report and rating action on Friday last week, where the outlook was revised to negative on the Trinidad and Tobago government's rating of BBB+, that there's been a flurry of media reports and commentary on the action itself. And in my mind, there's been a lot of misunderstanding as to, first of all, what a rating really means. Also, what has driven the revision to the outlook from stable to negative. And so I would be very grateful if you can clarify for us these points. What exactly is a sovereign credit rating? What does it mean and what does it not mean? What does the BBB+ rating mean? What's the definition of a BBB+ rating? And a negative outlook versus a stable outlook. So I'll turn it over to you now, Julia, to educate us on these matters. And then after that, we'll go to the question and answer session with our participants.
Okay, sure. Thanks, Marla. So as you know, and as you mentioned, we did last Friday on April 27th, affirm Trinidad and Tobago's rating at BBB+, and revise the outlook to negative from stable. So I'll first walk through what a BBB+ rating means, and then I will touch upon the outlook. So to start, our sovereign credit ratings reflect our S&P Global Ratings assessment of the sovereign's ability and willingness to service financial obligations to commercial creditors on time and in full. So the affirmation of the BBB+ rating therefore means that our view of Trinidad and Tobago's ability and willingness to service its financial obligations to commercial creditors has not changed since our last rating action, which was in 2017. And now, to give you a sense of our rating levels, our sovereign issuer credit ratings range from AAA, which is the highest rating that we assign, and means that an issuer's capacity to service its debt is extremely strong. And then the ratings go all the way down to the CC category, and then, of course, default or selective default, which would be assigned, of course, if an issuer has failed to meet its financial obligations on time or in full. So at the BBB+ rating level, Trinidad and Tobago is situated in the upper half of the rating scale, and is at the same rating level as some other sovereigns that we rate globally, and that would include sovereigns such as Poland, Peru, Mexico, Thailand. And according to our ratings definitions, an obligor rated in the BBB category has an adequate capacity to meet its financial commitments. However, adverse economic conditions or changing circumstances are more likely to weaken the obligor's capacity to meet its financial commitments. So that's the BBB category. Now, the addition of a plus to the rating, so in this case, bringing the rating to the BBB+ category, shows the relative standing within the BBB category. So in the case of Trinidad and Tobago, showing a higher standing within that BBB category, BBB+. So to determine that rating and get to that point, we incorporate factors that S&P Global Ratings has seen and believes to affect a sovereign government's willingness and ability to service its financial obligations to commercial creditors on time and in full. In the case of sovereigns, those 5 key areas that we use to determine a sovereign's creditworthiness, not only in the case of Trinidad and Tobago, but these are the factors that we look at globally, are an assessment of the sovereign's institutions, its economy, external accounts, fiscal position, and monetary policy. So I'll walk through those a bit. On the institutional side, we primarily look at how government's institutions and policy making affect a sovereign's credit fundamentals by delivering sustainable public finances, promoting balanced economic growth, and responding to economic or political shocks. In addition, the institutional assessment also reflects our view of the transparency and the accountability of data, processes, and institutions. So that's on the institutional side. In the economic assessment that we do, we look at the country's income levels. So we primarily measure that looking at GDP per capita. And in our view, that indicates the broader potential tax and funding bases upon which to draw. We also look at growth prospects and economic diversity and volatility. On the external assessment, we look at primarily external liquidity, which indicates the economy's ability to generate the foreign exchange that the economy needs to meet its obligations to non-residents, so those living outside of Trinidad and Tobago in this case, both in the public and private sector. We also look at the external position, so the asset position, so that shows residents' assets and liabilities relative to the rest of the world. On the fiscal side, so that's the 4th element that we look at, that reflects our view of the sustainability of a sovereign's deficits and its debt burden. And then the final element that factors into our rating is the monetary assessment. And that assessment reflects our view of the monetary authority's ability to fulfill its mandate while sustaining a balanced economy and mitigating any major economic or financial shocks. So that is a quick overview of what we focus on when we look at sovereign ratings across the globe. Now, let me get to the outlook. On the outlook, it's important to keep in mind that our outlooks indicate our views regarding the degree of likelihood of a rating change and the probable direction of that change. However, it's not necessarily a precursor to a rating change. So, as a reminder, our rating, so in this case, the BBB+ issuer credit rating in Trinidad and Tobago's case, it's a forward-looking opinion about the creditworthiness of the issuer. And that rating incorporates our assessment of future events to the extent that we can anticipate those events. However, we do recognize the potential for future performance to differ from our initial expectations. Mm-hmm. And outlooks, and in this case, the negative outlook in Trinidad and Tobago's case, address this possibility by focusing on the scenario that could result in a rating change. So the outlook addresses the direction that we believe the rating may take if our most likely scenario, our base case scenario, does not hold. So specifically, when we assign a negative outlook to issuer ratings, we assign a negative outlook when we believe that an event or trend has at least a 1 in 3 likelihood of resulting in a negative action over the intermediate term. So, and just to clarify, a negative outlook does not necessarily mean that an issuer has unfavorable credit characteristics. Rather, it indicates that the rating could move lower if the scenario upon which the rating is based does not occur. So in the case of Trinidad and Tobago, our negative outlook means that there's at least a 1 in 3 chance that we could lower the rating over the next 1 to 2 years. So, in our view, if the scenario upon which our BBB+ rating is based and our expectations about how the rating factors that I mentioned will evolve, if that does not occur, does not transpire, we believe it will be more likely that scenario more likely result in a weakening of creditworthiness, given that we think the risks that the outturn deviates from our base case are more tilted to the downside. So as we highlight, the main risks that could lead to such an outturn, in our view, are primarily the imbalances that we see in the economy. So that includes, for example, the exchange rate pressure, restrictions on accessing foreign currency, the negative yield differentials on short-term interest rates relative to those in the U.S. So those types of imbalances, we think there's a risk that could lead to a faster depletion of the country's external assets beyond what we currently expect, or a weakening of the effectiveness of monetary policy. So the other risks that we've highlighted are if the fiscal consolidation efforts, which are still relying to a large degree on one-off factors, if they fail to reduce the deficit to the size that we currently project, particularly given the much higher deficit that was recorded in the last fiscal year than had been previously expected, which could have negative implications for the size of the debt burden or debt service cost. Or if we view the institutional risks to be growing, as indicated in the government's ability to implement some of the key institutional reforms. And just for an example, we know that the National Statistical Institute and the Central Revenue Authority, those are two reforms on the agenda, and those are representative, we believe, of the government's ability to deliver sustainable public finances and transparent and accountable data. So these are the main risks that persist in our view, and should any of those risks materialize, which again, that's not our base case scenario, which is why we affirm the rating, but if those risks were to materialize, we could lower our view of Trinidad and Tobago's creditworthiness. So that being said, there are several factors that support the rating at the current BBB+ rating level, where it remains today, and support our decision to affirm the rating. So one of the strongest elements of the creditworthiness, and one that benefits both the external and fiscal accounts, of course, is the government's still relatively solid level of financial assets. And this is particularly relevant in the case of Trinidad and Tobago, given the volatility in one of the largest sectors of the economy, which is the energy sector. A large portion of these assets, as you know, are held in the Heritage and Stabilization Fund, which has accumulated value over the last decade, and that's even despite some drawdowns. And the fund, as you know, is currently around $6 billion. So in our view, these assets mitigate some of the risks of the country's level of fiscal and external debt. And additionally, although we do believe there will be challenges to substantial institutional reform, we do expect institutional stability to continue and to underpin efforts to return to sustainable public finances. And on that front, we expect the deficit to fall by nearly 4% of GDP this fiscal year, from almost 8% of GDP last fiscal year. More than half of that we expect will come from one-off revenues, including the sale of some of the units of the government's National Investment Fund. But some of this improvement we expect will also come from some of the revenue measures that were in place by the government this year. So we will, of course, monitor, as we constantly do, the evolution of the creditworthiness of Trinidad and Tobago, and carefully evaluate if any of the risks that I've highlighted actually materialize, which would lead to a deviation of our base case scenario. And if that were to be the case, we could lower the rating from its BBB+ current rating level.
Okay, thank you so much for that very in-depth and comprehensive clarification, Julia. I know I said we would switch straight to Q&A, but I did want to ask one question. You made a point about the institutional reforms that the government has articulated over many years, and two of them that you highlighted have not really been executed over the several years that they've discussed them. So the Revenue Authority being one, and the Statistical Agency. I just want to ask you your thoughts on, in particular, the Statistical Agency. With respect to other credits that you all have ratings for, how would you treat with this kind of a situation on a regular basis if there is this ongoing weak statistical infrastructure that has not been addressed over successive governments and over a long period of time? Is there you know, any kind of, how should I say this? Is there like a factor that you all consider more important or less important? How important is that relative to others? In other words, is what I'm asking.
Yeah, well, I think you know, our view is that this reform of the National Statistical Institute, which you know, the administration intends to implement by 2019. I guess the aim, as far as we understand, of that reform is to seek to address some of these historical shortcomings that we have seen in Trinidad and Tobago in the past. You know, we do recognize, especially I think on the external side, that there are some shortcomings in the data, and you know, we've seen how that can complicate some of the analysis. Particularly, I would highlight there, just as one example, the large errors and omissions that are recorded in the current account deficit, and I guess in the past, what we've seen is those errors and omissions have averaged almost 70% of the current account balance over the past 5 years, I think, for which we have actual data. So that is a high level, and we do, in our view, think that complicates the analysis, especially on the external side.
I agree. I share your frustration. This is my life too, right? Okay, so let's turn it over to the questions that have been sent prior to the call actually starting by those of our subscribers who couldn't attend, and also we have anybody on the line currently who wishes to ask questions. We can take those questions now as well. Thank you. Thanks, Julia.
Yeah, this is Melissa. I just wanted to remind those that are on the call that they can use the question box to submit their questions. They should see that the questions panel on their screen. The questions that I've received 3 by email prior to the event, so I'm going to go ahead and start with that. Julia, you said in your report that the government's fiscal accounts rely heavily on the energy sector. And you also said that stronger energy sector revenues will contribute to shrinking the fiscal deficit in the next few years. The Minister of Finance said in the budget speech last year that the government will essentially receive no energy revenues from the new projects coming on stream for several years. Is the only avenue to recovery then oil and gas prices? And what else did you take into account in your analysis?
Okay, yeah, thanks, Melissa, for that question. So, as I mentioned, in our analysis, we do, you know, in our forecast, we believe that the government's fiscal deficit will decrease over the next several years, and the largest drop in that deficit we expect to see in the current fiscal year, from a high of about nearly 8% of GDP in the last fiscal year down to about 4% this year. And so the sources of that decline are multiple, but I think as we kind of highlighted in our report, we do expect more than half of that improvement will actually come from the sale of units in the government's National Investment Fund, which I mentioned. And so the fund, as we understand, will largely be composed of shares of companies that were part of the CL Financial conglomerate that of course failed almost a decade ago. And we understand that the government now has received the legal authority to sell the underlying company shares. So we think that will contribute to, at least in this current fiscal year, a large chunk of the reduction in the deficit. And then there are also a few other measures that we have incorporated into our forecast for the fiscal deficit, and those also include, of course, the application of this new uniform royalty rate, so the 12.5% royalty rate that is applied now to both oil and gas production, and then, of course, the increase in the corporate income tax rate. In our view, those will be kind of the largest contributors to this decline that we see in this fiscal year.
Julia, just along the same lines of what you've been discussing, I've gotten a few questions in, so I'm going to skip to one of those right now. You said in the report that there would be a 12% increase in gas production, and it seems that you've considered gas production is increasing pretty significantly in 2018 and 2019. Is that right? Have we understood that correctly?
Yeah, so as we mentioned in our report, we do expect gas production to increase by about actually 13% over the next 2 years. And that is incorporating the startup of some of these new sources of domestic gas production in the country. So we have incorporated that assumption into our analysis.
I have a few questions I've received about the forecasts on the tables at the end of your report. One is related to real export growth. I'm going to start with that one. You're showing growth of 1.6%. This is real exports this year, and 2% to 2021. Historical data shows 24%, 16%, and 31% contractions over the prior 3 years. So 2% growth is nowhere near a recovery. Is the one-off sale of government assets and the use of Heritage and Stabilization Fund basically how you see an external financing needs, the external financing needs being covered?
So in terms of external financing needs and how those will be covered, we do expect some capital inflows, not only in 2018, but over the next several years. And that is mostly due to some investments that we expect to come in from energy companies in particular. And that's kind of the largest source of the external financing that we expect to meet some of the external financing needs in the economy. That being said, we don't expect that those financing sources will be sufficient to stem the decline in net external assets in the economy. So we do expect reserve levels to continue to fall a bit over the next several years, and then kind of stabilize by the end of our forecast horizon in 2021. So we do forecast some FDI inflows on the energy side, but again, we don't expect the external financing sources to be sufficient to stem the deterioration in external assets, in particular the reserve levels at the central bank. Although we do expect those to stabilize out in the later years of our forecast.
Also regarding the tables, Julia, we've got another question regarding your real GDP growth forecast for 2018. Your forecast is 1.6%, and for 2019 to 2021, it's also much more robust than we've seen from the IMF and even from Marla herself. So what is the basis of this growth projection, and how would underperformance of this GDP growth forecast impact external vulnerabilities or the rating?
Okay, yep, sure. So as you mentioned, we do forecast the economy to return to growth starting in 2018. We expect GDP to grow by about 1.6% this year, and then pick up to 2% thereafter over the forecast horizon. And we expect that growth will largely be driven by the operation of some new fields in terms of energy production, but also modestly higher energy prices as well. As you know, the economy in Trinidad and Tobago there is a large energy sector, of course, which contributes about 1/5 of the GDP of Trinidad and Tobago in current prices. And so that expected increase in gas production that I mentioned of about 13%, and natural gas exploration extraction accounts for 1/3 of the energy sector. So that's the largest portion of the energy sector. We expect that to be a contributing factor. In terms of our oil and gas price forecasts, we do expect oil prices to pick up a bit, as we've seen actually already in 2018. We expect that our S&P Global forecast for oil prices is that they'll stay around about $55 US dollars per barrel in 2018, and then stay kind of steady through the rating horizon. And we do expect gas prices also to remain at about $3 US dollars per million BTU over the forecast horizon. So we do expect those sources of growth to help the economy, pick up a bit. That being said, we do expect there to still be some restraints on the economy, which is why we don't expect GDP to grow even higher despite this increase that I mentioned in production. And those factors would of course be the shortage of US dollars in the banking system, some of the private sector investment uncertainty, also given the fiscal consolidation, some contractionary fiscal policies, and the current despite the pickup, there's a current gas supply shortage as well. So we think that all of those factors will restrain growth a bit. And also I'd like to mention that what we've seen over the past through the economic cycle. So when we look at trend growth, in real GDP per capita, what we see in the case of Trinidad and Tobago is that it's still relatively low and below what we see in terms of trend growth in other economies, other sovereigns around the globe that have similar levels of income. So we do expect that to remain going forward despite kind of this small pickup in growth.
Julia, the next question: within the next year, what is the most critical issue the government will have to correct to prevent a worsening in the rating?
So, as I mentioned in our outlook, there are a few different factors that we'll be looking at, and if any of those risks materialize, any of those factors could lead to a lower rating in our view. So just to go back to those, if we see that, for example, the imbalances that I mentioned, if those imbalances lead to a faster depreciation of the country's external assets, or a weakening of the effectiveness of monetary policy. That could lead us to lower the rating. We could also lower the rating again if the fiscal consolidation is slower than we currently expect, and that, as I referred to earlier, could of course have negative implications for the net general government debt levels or higher interest payments. And then also, if the government is unable to implement some of these key institutional reform measures, such that the collection leakages on the revenue side continue, or the weaknesses in data provision, as we discussed, if those were to continue. So all those risks, which again are not in our base case scenario, but if any of those were to materialize, those could lead to a lower rating.
Along those same lines, and we've got a question that you don't replace lost GDP just with fiscal funding, taxation, using hard-earned reserves, borrowing, and disposing of state assets. And you were just commenting on the institutional reforms. The comment goes on to say that you do so by creating a framework for business to be frictionless and efficient, thereby encouraging investment. Could you comment a little bit on how this goes into the rating and what you would like to see as far as this type of reforms, business reforms, goes in order to see a change in the rating, or to have a positive impact in the rating?
Sure. So I think this speaks to a government's institutions, and that is one of the pillars that we look at as a foundation to a sovereign credit rating. And on the institutions, what we are primarily concerned about, and what we have seen to impact sovereign creditworthiness in the past, is how institutions and policymaking affect credit fundamentals by being able to deliver public finances that are sustainable, that promote growth in the economy, and policies that are able to respond to the external context and economic or political shocks. And we also look to the institutions and to what degree there's transparency in the sovereign, and how accountable the sovereign is in terms of data, processes, and institutions. So all of those factors play into our analysis on the institutional side, which is, again, one of the 5 main rating factors that we look at, not only in the case of Trinidad and Tobago, but also with other sovereigns globally.
Julia, how damaging is the heavily managed exchange rate to the health of the economy in the medium term? Could you comment on that, please?
So we do, in our view, think that there is some exchange rate pressure, and that's one of the that's one of the imbalances that we highlighted earlier. And we think that there might be risks that could lead to a depletion of external assets beyond what is incorporated into our forecast. And in our forecast, as I mentioned, we do believe that the central bank's heavy intervention in the foreign exchange market will continue to weigh on reserve levels. That is actually incorporated into our base case analysis. So that is a factor, and we look at that on both the monetary side and the assessment of the monetary authority's ability to implement monetary policy, but also on the external side and how that intervention impacts the external asset position of the country.
I have right now just one more question in line, and then I can turn it back over to Marla if we don't get any more to see if she'd like to ask any more questions. Just a reminder, you can use the question panel to submit your questions. This question is there an implied assumption of a decrease or zero increase in debt service ratios with GDP unlikely to grow significantly and external financing inflows likely to be of limited impact?
Okay, yeah. So as you'll see, I guess in our report, we did see debt service levels increase a bit, specifically interest payments in the last two fiscal years. And we do expect those interest payments to remain a bit higher than we've seen historically in this current fiscal year. Part of that is due, of course, to some of the short-term financing that was required given the higher fiscal deficit that was recorded in the previous fiscal year. We do expect those interest levels to fall a bit over the next 3 years, in line with the reduced financing needs from the government side and moving some of that short-term financing to longer-term financing. So we do expect those to go down a bit, but still stay higher than we've seen historically in the past.
Marla, I don't have any more questions in line at this time. If you want to go ahead and ask anything further in the meantime.
Right. Yes, I do have a question here with respect to the table and data that you guys put out in your report, Julia. So it's with respect to the primary balance as a percentage of GDP. And we're seeing successive years of a primary fiscal deficit, which means that the government is already in deficit before it services the interest on existing debt, which means that the government is borrowing, in effect, to service the interest only on existing debt, let alone the principal. We do have a couple of maturities coming up. We have a Petrotrin maturity next year. We have a 2020 maturity on the sovereign side. And I just wanted to ask you about refinancing risk and the fact that we have these maturities. Yes, we have some buffers that will provide the liquidity if necessary to service the debt and repay the principal even. However, I'm pretty sure that the government would rather not draw on the reserves if it's avoidable to service these obligations. So what is your assessment of the refinancing risk, in particular with some of the upcoming maturities for the external debt?
Mm-hmm. So I guess on a few different points, on the Petrotrin maturities, we do take note of those maturities, specifically the $850 million that is due in 2019, as being the closest debt maturing on the Petrotrin side, I guess the largest and the closest. We do incorporate that and Petrotrin's other outstanding debt into our analysis of Trinidad and Tobago's the government's contingent liabilities. As you probably know, the government actually does not guarantee that debt in particular. However, we do believe that there is a very high likelihood that the government could step in and support Petrotrin, given just the importance of Petrotrin to the economy and to the government, if that were to be required. So we incorporate that debt as well as the other non-financial public enterprise debt that is not guaranteed, that we incorporate into our direct debt measure, but we incorporate what is not guaranteed into our assessment of contingent risks to the government. which we view to be moderate. They do represent about 14% of GDP, so that's what is not guaranteed by the government, and that does factor into our assessment on the debt side.
Okay, thank you. Well, do we have no more questions, Melissa?
Actually, I just got one more. Julia, how important are the government's projections on oil and gas production for the rating and the outlook? And if these were to change, improve, or deteriorate, what do you expect would be the impact to the rating, or are they just not that important?
Okay, yep, sure. So we do incorporate the information that we receive from the government and also from the different sources and private sector representatives as well. We incorporate all the information that we receive into our own forecasts for not only on energy production in particular, but across our forecasts that are included in our report overall. It is a factor, and we have incorporated into our analysis, and we do include in our report kind of what our assumptions are in terms of energy production and the evolution of that, and as well as energy prices.
Okay, well, somebody saved the $1 million question for last. Okay, so I guess we can wrap up.
Yeah, I don't have any further questions in line.
All right, good. Julia, of course, I mean, you have my deepest gratitude for spending this time with us today to explain much more clearly than anyone else can, of course, what your rating means for Trinidad and Tobago and what the negative outlook means and what goes into arriving at this rating. Of course, all of your explanations and answers to the questions as well provide much needed clarity, and I just want to express my deepest appreciation to you for that. And I look forward to having you again on a webinar so that we can discuss these matters whenever you have a rating action or even inaction. I really look forward to it again. Thank you so much.
Thank you to you, Marla, as well. It's my pleasure, and I look forward to being in touch.
Yes, great. And thank you to everyone listening on the call. I hope you found it useful, and we look forward to getting your feedback on this session. Thank you. Have a good evening, everyone.